So thanks for everyone that joined so far, and we'd like to really thank Spark Festival for putting on another successful year. Good to see that they've returned and all the events over the last week or so. So this webinar that we've put on today is on the topic of funding for startups. It's tailored towards kind of really early stage founders who are just looking for a consolidated a consolidated set of information just around the various funding strategies available to them. We've got Cam from Leadstory here with us today, which we're very excited about. So just a quick disclaimer, as always, the information in this webinar should not be taken as specific tax or legal advice. You should always talk to your accountant, lawyer, other advisors before engaging in anything in this presentation. So Fullstack, for those of you who don't know, who aren't familiar with us, we're a chartered accounting firm specializing in startups, entrepreneurs, tech founders, that kind of thing. So we're really the one-stop shop for those kinds of businesses who are looking for advice and services, from setting up the company, doing that early stage advisory, helping with R&D, tax, grants, things like that, and then scaling up. We do also deal with scale-ups and have some very large clients. So Leadstory, Cam, I'll just throw it over to you. You want to give a bit of an intro?
Thanks, Jack. Hi, everyone. I'm Cam from Leadstory. I'm the co-founder and CEO of a business that's 2 years in. It does what it says on the slide. We're building a personalized news bulletin for your smart TV. We're in a nice phase now where we've gone from a couple of years of surviving to we're in that really nice phase of scaling. We've just done a great deal with Samsung. We're getting our channel into about 20 markets over the next 3 months. And yeah, Jack and the Fullstack team helped us to stay afloat for the last 2 years so we could get to this stage.
Cool. And we've also got Andrew Lee here with us. So I'm Jack, the R&D tax manager. We've got Andrew here, who's the assistant R&D tax manager. So there's quite a lot to get through, and we've got Cam here, who I think everyone will probably be more interested in hearing some real insights and Cam's experience rather than just us reading off the slides. So I guess initially there's a number of factors to consider when pursuing funding. One of the main things there is whether to raise funding through equity or through debt financing. Equity is generally more common as you're scaling up. Maybe some of those early stages are more kind of debt where you're loaning money to the company yourself. And it is more common kind of in those later stages where maybe you're established enough to get debt facilities from a traditional financial institution, that kind of thing. So equity, I'm sure a lot of you already know, is raising capital through shares. So people buying and purchasing shares in exchange for certain rights. And those shares can increase or decrease based on how the company is going. Equity financing generally won't have to be repaid. So that's one of the positives there. Debt financing, obviously, loans where you're getting debt financing that will have to be repaid generally. So there's a lot of considerations. The cost of raising funds, the time, networks that you're plugged into can help with that. There are short-term versus long-term goals which may lead you to a certain type of equity financing or debt financing. There's the various obligations, and the control from other stakeholders will vary depending which those routes you go down. And so, as I said, over the course of the business life cycle, there are different capital needs, certain times where you might need quick funding, so equity versus debt may be appropriate or not, depending on those specific situations. And so just quickly, bootstrapping is those early stages where you're self-funding using sweat equity, relying on savings, credit cards, that kind of thing to fund and try and just whatever comes in kind of goes out the door, and you're always kind of rolling those funds over. One of the major advantages of that initially is the ability to maintain control of the company for the founders, testing that viability of those products early on, although it may lead to considerable financial strain if you're just constantly putting your own money into the business. So Cam, what was the point in time where you first, I think you kind of self-funded initially, but then there was a point in time where you decided, all right, this is a serious business, let's go out, let's raise?
Yeah, so we bootstrapped for probably the first 6 months, but in the end, we didn't really have a choice. We were going out to build a global video streaming platform. The cost of deals with video providers, the cost of deals with content providers was tens of thousands of dollars a month. There was a really obvious point at which we knew it was a business we wanted to go and do. We had a good founding team, and we looked at each other and said, all right, let's do it. Let's quit our jobs. We had a bit of an unusual process. We went through an accelerator, we went through Antler, and we were offered funding, but we politely declined it. And after that point was when we said, all right, we've got to get serious about it. It was about 3 months from that point to raising a round, but at that stage, we knew we had to go all in. And I think there'll be a time for most businesses when, and ours is a little different from others, when there's a lot of cost considerations, but there'll be a time when you realize we've got to go for it. We've got to supercharge it. We've got to pour kerosene on the fire. And that's the stage at which bootstrapping probably ends.
Yeah, so this takes us through the kind of main stages of equity financing. People do have kind of different conceptions of what exactly each of these are, but this is just a bit of a general rule. And obviously, as you kind of go through, there are different obligations, different funding amounts, different mechanisms, different purposes for those different stages. Yeah, so equity financing. So as I said, raising funds through selling shares, i.e. the ownership of the company. You might have different classes of shares as well. They give different rights to distributions, rights to voting, that kind of thing. Equity financing, there's no obligation to repay funds, which is good. But obviously, giving up part of the company can be challenging for people who don't want to give up something that they've built, but managed effectively. It can be great, obviously, for the companies, but the founders as well. It's taking, giving away some of the company, but gaining a lot more in return. A lot of those VCs and things like that will have expertise, skills, networks that they can really leverage to assist the company and help it grow. So as I said, there are some flexibility can be obtained through there with preference shares, but there are reporting requirements as well to ASIC. Obviously, the kind of worst case scenario is you get an investor that, something happens, you don't get along with them, or they want too much, or there's a differing opinion there, then sometimes them having that ownership can cause issues with that. But hopefully, those can be managed effectively. So Cam, there's the sources of equity funding. Obviously, personal, family, and friends is often the first source of funds. Generally, the most kind of simple in terms of the terms, handshake agreements, that kind of thing, although handshake agreements with family maybe not always lead to the best outcome. So you need to be aware of those risks, make sure that you are regularly having a look at the cap table, making sure that there's not all those handshake agreements are formalized. So when future rounds, future raises come, there aren't those negative impacts on the cap table. Angel investors, that kind of is the first step often in the journey for getting outside investment. They are commonly individuals, high net worth, that are, kind of willing to give those funds at those early stages, but for a high return. So you might be giving away quite a large piece of the company there in those early stages. VCs that obviously come in generally in those later stages when the company is a bit more mature and providing those larger sums and the access to those networks and that kind of thing. So Cam, your first kind of major raise after that initial accelerator was through Capital Pitch. So can you just tell me a little bit about what that decision was like going from that early stage? That VC, had a couple of different offers, I think, and decided to go with Capital Pitch. What were some of the main considerations in choosing who to partner with?
Yeah, so ours was a pretty unusual raising experience. We did what most companies do. We put together a pitch deck. We got the list of emails from VCs, and we just sent them out hundreds and hundreds of pitches. And one of our first returns for a call was CP. So we sent the emails out. I remember on a Monday morning, I'd taken the week off work so I could be fully focused on it because I'd gone back to working at that stage. And they were our second call. And I was about 20 minutes into the call. Chris and Emma are partners. And Chris stopped me and he said, I don't need to hear any more, Cam. And I thought at that stage that they're not interested, they're out, because the first call had gone pretty bad. And he said, we're in under one consideration, and that's that you don't speak to any other investors. We're actually going to give you more than what you're asking for at a higher valuation than what you're asking for, because you're going to need more money than what you say you're going to need. The condition is that you don't speak to anyone else after this. And we took it because we liked them, first and foremost. And secondly, because they got it. They just got the business. We're operating in a space that a lot of VCs won't really touch. Media is not a particularly attractive investment vertical at the moment. There's not been a lot of venture scaled media businesses in the past decade. We primarily monetize through advertising. We know that advertising is not a particularly attractive space. For VCs, they're looking for B2B SaaS businesses primarily, especially here in Australia. So when we had a VC that instantly were like, yes, we get it. We like the team. We don't think you necessarily have a hold on what the product might be, but we think you guys will figure that out, which in the end has been pretty accurate, because what we were pitching them is quite different to what our product has ended up scaling the best. But I think for a lot of other businesses, it will be a much longer process. It will be weeks and weeks and dozens of calls, because post that pre-seed raise, our seed raise was a much more standard raising experience where we have hundreds of awful calls and VCs saying pretty unflattering things about your business, but you only need to find a couple. You only need to find half a dozen who get it, who believe it, who can see the opportunity, and those are the investors who you want.
And it's probably even just having those potentially awkward or uncomfortable conversations early to kind of put yourself out there and actually get feedback, accepting that people aren't going to necessarily love your business right out of the gate, and just kind of getting out there, getting feedback.
Well, I always structured it. I played cricket growing up, so I always structure it. You get in pitching form, so you got to play a few overs. You got to have a few pitches that won't go so well, so you can get to the pitches that you want to go well, and all the questions that are coming your way, you've prepared the answers. So I would have a list of VCs or angels who we wanted to talk to, and the top of the list would be the ones who we didn't particularly want on the cap table. We'd speak to them first, and we knew that they wouldn't really be interested. We knew that we might be a bit early for them, so we could refine our pitch. And by the time we got to what we call our tier 3 investors, we probably had 50 calls. We probably had 48 no's. We probably had half a dozen people who said we should be doing something different with our time, and you could really nail those pitches that you knew you needed to nail. And that's in this most recent round, we got to that stage after quite a few calls, and we were pretty well prepared.
Right. There's a few different types of equity, and the kind of equity that you obtain will vary often depending on the stage of the business. So that early MVP stage, often that's sweat equity, where the founders just putting in their time, not necessarily getting any monetary recognition for that, and potentially putting money into the business through loans, that kind of thing. Although you have to be a little bit careful and cognizant of the impact of things like loans on the balance sheet when you are speaking to those angel investors, VCs, that kind of thing. And then as you scale up, maybe reaching out to those accelerators, giving away a little portion of the company for an investment and scaling up those VCs. So Safe Notes, this is a mechanism for raising funds in the form of equity generally that we're seeing a lot more. It's kind of an innovation through Silicon Valley. It stands for a simple agreement for future equity. Essentially, these are agreements where an investor and a founder, potentially an outside investor, maybe an even employee, puts money into the company in exchange for a right to purchase stock at a time in the future. Maybe when you do that in a stage 1 raise, then that's when those notes convert, and then that's when those shares are issued. So Cam, I think that Leadstory's employed the use of Safe Notes fairly extensively.
Yeah, our first round was an equity round, a price round, but then subsequent to that, we raised on safes. And I think safes are good for a couple of things. They're not right for everyone, but they're for businesses that are pre-revenue or low revenue. If you're raising a priced round, investors are going to want to justify that price. They're going to want to say, well, you're making 10 grand a month, so we're making 120 grand a year, so we're going to give you a valuation of 1.2 million or something like that. When you're raising on safes, which is early, you can say, we think by the time we raise a price round that we will be beyond this. We'll be valued at, we're going to raise a safe on a $10 million cap with a 20% discount if we don't hit that. And so you're betting on yourself. And investors don't have to go trawling through, they will, but they don't have to trawl through your projections to justify that valuation, because it's a safe, it's a lot simpler. They're betting on your success down the road. And from experience, you can send out a safe on a Monday and you'll have the money in your account by the Friday. A priced round, it is probably more like term sheets out at the start of the month and money in 6 weeks later.
Yeah, I think that there are a lot of resources out there around safe notes that are often very kind of standardized. That does reflect those lower or potentially the higher risks for those initial investors, but the kind of lower obligations for the company. Safes potentially won't convert ever, right? If the company doesn't go as well as they think, or they don't end up getting to that equity round, then the investors lost their money and those safes never convert. So very simple to set up, as I said, low level of negotiation. They're not debt. You just have to be a little bit careful though, making sure that you're on top of your cap table and you kind of know those impacts, what those impacts will be. Having a bunch of safe notes, what the kind of impact on the valuation is when you are speaking to VCs and trying to raise those larger amounts of money. There is also an interesting interaction with the ESIC tax offset that we will cover, and we'll cover that offset a bit later, whereby those concessions potentially will be lost because you don't actually get the equity until the note converts. You can also use it to your advantage potentially to delay those conversions to get more ESIC tax offset. So there are some requirements around ESICs that you should be aware of. Into those in great detail here, but sorry, not ESICs, safe notes. So always talk to a lawyer or an accountant or both before engaging in any of those schemes. So employee share option plans are also a useful way to delay giving away part of the company. So similar to a safe where you give your employees the option to take up shares at some future point in time, potentially taking a lower salary today. Cam, you have a few ESOPs in place. Can you explain how they've managed, how you kind of use them to leverage your financing?
Yeah, so ESOP is a portion of the business that you allocate for staff, for advisors. If you're in the case of Facebook, you pay some ESOP to the guy who spray painted the foyer and he ends up making $2.5 million from a job that probably could have cost $5,000. But essentially it's assigning value to a portion of your business that you haven't exited yet, that you can then assign to people like advisors who probably not going to have the capital to go and pay to bring on staff that might have to take a bit of a lower wage, and you give them a portion of the ESOP that they then have those shares. They vest, so it takes a bit of time for those staff or those advisors to have those shares vest, so maybe they get it over a 3-year period, and so it means that they have skin in the game. But I think more than anything, it gives your people reason to follow the journey with you. And that's when we're bringing staff in, it doesn't matter what they do, we give them shares, we give them ESOP, because then they're all pulling in the same direction. And if they have a portion of the business that say now is worth 25 grand, if we go on to be a unicorn, it's worth $1 million to them. And you saw how many examples of Canva staff having some really serious exit events, and we think it's enormously valuable. We've allocated 15% of the business. I know a lot of other businesses are 10, but for us, if our staff are pulling in the direction that we need the business to be pulling in, then its chances of success are so much higher.
So there is some support for equity financing from the government in terms of the early stage innovation company concessions. Andrew, do you want to just give a quick overview of those?
So the early stage innovation company concessions are a tax offset for investment in ESICs. So the benefit really accruing to the investor rather than the company itself. As a company, the main benefit is that you become a more attractive investment. Or investors, sophisticated investors, can invest up to $1 million in you. They can invest more, but the tax offset caps out at that 200,000 mark. So they receive a tax offset in the year that they invest up to $200,000 or 20% of the investment amount. And the other investment benefit that investors receive is that the disposal of those shares, if it occurs between 1 year and 10 years of holding the shares, then the disposal event is CGT free. If the share was disposed of, say, in the 11th year, then the cost base of that asset or the share is the market value of it at 10 years. So it's basically a tax exemption on the appreciation of that share over a 10-year period.
Yeah, and so there are a few requirements to demonstrate in your ESIC. We won't go through in great detail today. We do have some other materials on our website and on our YouTube channel. So just something to keep aware of, and it does sometimes require a little bit of planning just to kind of make sure that to manage those various tests to make sure that you're still attractive to those investors. So debt financing, this is kind of the opposite side of the coin to equity financing. Essentially, you are being loaned money that you have to repay at some point. The pros are that you don't have to give up ownership of the company. The interest repayments are actually tax deductible, although you're still paying something. And you can potentially leverage a small amount of money into a bigger, a larger sum. The cons, obviously, you have to repay. So debt financing generally, especially in the early stages, much more uncommon, apart from where it's founders putting money into the company. You know, if I put in $100,000 and write it up as a loan, that sits on the balance sheet until such a time that it can be repaid. But in general, debt financing is often for those more established companies that have, you know, proven track record, that have regular revenue coming in, that are a bit more sophisticated, and they can demonstrate to traditional banking institutions, or non-traditional, that if I borrow money today, I'll be able to repay you interest every year and then the principal at some point. There are also some other examples of debt financing that are maybe a little bit more easy to access than those traditional kinds. So the R&D tax finance is one that is becoming a lot more popular, that essentially allows you to borrow against your future R&D tax offsets. And so, Cam, you've employed that to pretty good effect.
Yeah, so R&D tax offsets, I think, are one of the best parts of the tech ecosystem here in Australia. I don't know anywhere else in the world that does it. The fact that you can get a tax return which is more than the tax you paid in the preceding year, and you can put money towards some projects which are things like development, things like R&D. We engaged a facility through a contact that you put us in touch with because we needed to over-index our launch on Samsung in June. We wouldn't have received that funding until circa September time. We wanted a fairly sizable marketing spend to make sure that channel worked, because if it worked, we knew that we had a global deal on the table that would get us into 20 markets. And so we brought that money forward. I think I'd copped a bit of interest payments, maybe about 7% of the overall amount, but I was happy to pay it because the channel worked, people watched, and we got that deal. So it was a bit of a gamble. It was worthwhile. And R&D is, as a whole, you just got to do it. You got to put thought into it at the start of the tax year, and it is money for Jan.
We'll discuss the R&D tax incentive in a little bit more detail in the following slides. There are some other examples there. Grant advances, I'm not actually sure whether anyone in Australia is currently doing those, given situations with companies that did provide that in the past. Revenue-based finance as well, that's maybe one more for kind of SaaS businesses that have kind of can demonstrate regular, consistent revenue over a period of time, and they can kind of borrow off those future revenues. These are the R&D tax incentive finance, especially, is where it makes the most sense. Is if you could spend more on R&D, you would. You know, if I have $100,000 in year one, but I would spend $150,000 to $200,000 if I could, bringing that into the tax year, increasing your R&D, bringing your commercialization forward. As Cam said, it kind of evens out in the wash because your R&D tax incentive goes up and that is generally enough to cover the interest and the finance of the principal repayments. So grants, this is the one that a lot of people get excited about, the quote unquote free money. Don't quote me on that. It's not free. There are a lot of requirements around those that everyone should be aware of. So government grants, they kind of sit in this area. It's neither equity nor debt, although there are some that have certain conditions or convert to debt at certain points in time, require repayments, but generally they're schemes where you can get up to 50% of the money spent back. I do like to separate grants and incentives into kind of two categories. There's the broad-based entitlements or grant programs that are easier to access and you don't have to compete against other people, and then there are the competitive and merit-based grants. They both have their place. So these generally don't require companies to give up equity or repay funds. And those entitlements, you need to be aware of the requirements, but if you qualify, then you probably should claim those. On the competitive side, those competitive grants, or the competitive grants require you to have a project, so very well-defined project plan with a budget, with plan, with milestones, etc., with the resources required to be able to carry out that. You need to demonstrate to the government, often competing against other people, that the government should put public, funding, taxpayer money into a private enterprise. The merit criteria is generally similar across these grants. So demonstrating the market opportunity and your value proposition, that you've done your research and your customer base, that you have the ability to carry out the project, so you have the personnel in place, that you've already reached out and got agreements with future employees, with contractors, with third parties that are going to test your MVP and help you commercialize. And you need to demonstrate that there are significant benefits to the broader Australian economy. So jobs in regional areas, you might get bonus points, things like that, being in an area of national priority. So often things like health, infrastructure, defence, etc., are more agriculture, are more highly rewarded through these programs. And so Cam, you have had a mixed experience, I think, with grants over the years. Would you like to talk a little bit about the accelerating commercialisation? What were some of the key so Leadstory was successful in receiving an accelerated commercialisation, although it did take a long time. So can you just maybe give us a little bit of a walkthrough of your experience with that and some of the things to keep in mind?
Yeah, sure. So accelerating commercialization saved us. There's no doubt in that. We were still iterating, trying to find product market fit, and we're probably not at a point that we would have been able to go back to investors and either get money in at all or get money in at favorable terms. And the first thing I would say is it was a lot of work. It was a 6-7 month process. I think the application in the end was 14,000 words. It was, 2 months of doing a thesis at university type level work. And at the end of it, I'm not afraid to say, we're in a point where we weren't too far out of running out of runway, and the government went and announced an election, and it meant that accelerating commercialization was going to a decision at a time when they were going to enter caretaker mode. So I think there was about a week and a half there where the facilitator rang me up and said, we've either got to get it to go before the panel in the next week and a half, or you've got a 3-month wait until the government exits caretaker mode. And then we don't know whether the program will continue after that, which we now all know it hasn't. And so we were incredibly lucky. We got it before the panel, we got accepted, and it was funding for the business that was, yes, equity free, but it gave us a lifeline. And beyond that, it gave us a product that delivered our product market fit. It was our early source of revenue. It worked. And the work that went into doing that application meant that we had to go out and speak to people in the industry. And by the time the project was finished, those people in the industry were the ones who were buying the product. So yes, bad in that I went grey and my co-founder went bald through that 6-month process, but good in the fact that a sizable amount of money that really led us to the point where we are today.
And was the experience, and in terms of the due diligence and the things that you had to get together, is there an analog to raising for VC? How do you see that? Are they quite similar?
Yeah, I think it's a really good process for just how thorough that whole application was, you get a whole lot of information that you've got to put together into an application. And having that information for when you go to raise, it's almost like a data room. They make you go through some really robust projections. They make you go through some really robust risk analysis, a risk matrix, which we would never have ordinarily done. I had a VC come to me a month ago in the middle of the raise and say, we need a risk matrix. Do you have one? And we did, because we did it through accelerating commercialization. So yes, I think it prepares the business to move from a scrappy startup to a scale up to a business, and makes you think about the project and what you're trying to build in a far more robust way.
Yeah, accelerating commercial, we'll touch on a few other grants that are worth looking out for shortly. You also had you were successful in signing an agreement for the New South Wales MVP that then went away because, again, of that political risk, the change of the government. So I think that probably was a lot more straightforward. It's good to maybe get a little bit of practice with some of those more incentive-based programs. Like MVP used to not be highly competitive. It's just if you ticked all the criteria, then you'd get it. So maybe a lesson there is looking at some of those lower ones in the early stages, just having a crack, having a go, and starting to learn and understand what those processes are like.
Yeah, and I mean, it is disappointing that programs like accelerating commercialization and MVP ventures have paused. I think they're enormously important for our ecosystem because it lets businesses that might not be traditional VC businesses, a la Canva, get some money through the doors that lets them go out and build their products and lets them go to market that maybe a VC isn't going to fund them to go and do that, but a grant might. I really hope they come back. It's important to note that this is not money for nothing. So it's matched funding. So for AC, we had to put up a couple of $100,000 to get back a couple of $100,000. Same for MVP Ventures. And R&D, you have to spend the money on those projects in order to get the 43% return from the tax. So you do have to take that into consideration if you're going after these grants and you think you're a shot. That's probably a time to speak to an investor or a time to speak to a lender of sorts to try and increase or get the money that you can to make the application. And in our instance, the conversation with investors wasn't, we need funding, it's we have this grant opportunity, we have this opportunity to get this money to build this product. If you put a bit more money in, then we can go and build this product and it will return this. And that was a very different conversation with investors as opposed to, we need money to survive.
So just on that grand snapshot, won't go through this. There are a lot more that we haven't been able to fit on this slide. Maybe just take a screenshot of this or look at the slides later when we send them out. You'll see there are some, so accelerating commercialization has now closed. That was the kind of big post R&D broad-based scheme to fund commercialization projects. That is being replaced maybe, or the industry growth program is the big Labor kind of initiative under the National Reconstruction Fund, which has been, or the mechanism to provide those funds has been legislated. So we're still waiting on what those programs will actually look like. They've identified the 6 priority areas. A lot of these, so the MVP New South Wales one is currently under review again. I think it came out of review and now it's gone back in. There was some information about that this week, about that review. A lot of these are rounds, so they'll have yearly rounds. The Ignite Ideas Fund, the WA Innovation Booster, I think the Made in Victoria are yearly rounds. So it's just about being kind of ready. So having a project plan, having a budget, having all those things in place that I've spoken about, ready to, when something comes online, you can quickly adapt the materials that you already have prepared to that specific grant. And like I said, the merit criteria are often very interchangeable, very similar between these different projects. It was just a comment around from one of the attendees that where B2B SaaS that went in for accelerating commercialization was unsuccessful. There was some feedback that it was difficult for software companies to get that just because of the nature of the IP and how novel it is. Yeah, that's a really interesting point. And I mean, certainly in my experience, the tangible products are a lot easier to kind of sell politicians to go out and go to a factory and say, we built this factory in regional New South Wales, it's going to create jobs, that kind of thing. So yeah, I think that is a good point. There is a bit of a slant often to non-software. That's where things like the MVP, New South Wales, some of those other grants I mentioned were good because they kind of filled that void. They're a bit more entitlement based and very suitable for software. So hopefully that'll come back. I did see a report, it's not surprising, but the largest category of claims in the R&D tax incentive now is software, accounting for more than a half, I think. So there is always the R&D tax, and maybe it's worth the government revisiting just some of those criteria around that to, kind of bring that legislation up to date around software. So R&D tax incentive, mentioned a few times, that's the broad-based scheme to incentivise experimental R&D activities conducted in Australia. 43.5% refundable tax offset. So even if you are pre-revenue, you still get something back, and quite significant. There are a lot of requirements around that, and a requirement to keep records. So if you're interested in discussing that in more detail, please contact us. As Cam said, talking about R&D finance, that's really the kind of gold standard. If you're eligible for that, claim it. Make sure you keep records. MDG, this used to kind of be like the R&D tax incentive in terms of being retrospective. Now it's more prospective. The lead times are quite long, and they've really gutted a lot of the funding out of that program. So it's worth keeping an eye on. It will provide you with up to, and it is up to, probably not 50%, up to 50% of your export market development expenses. Google AdWords, Facebook ads, Instagram ads, employing overseas contractors, producing samples for overseas, etc. Crowdfunding is an interesting one. So crowdfunding, we do have a few clients that have very successfully crowdfunded. There's the kind of traditional Kickstarter method where you put something up and get people to kind of pre-purchase it. That's something to think of. There are, over time, the rules around those, what you can and can't do, become more kind of stringent. So make sure that you're doing everything that you need to do, not exposing yourself to any undue risk there. Equity crowdfunding as well is something that we're seeing a little bit more on. Those are some of our clients who have successfully crowdfunded potentially quite significant funds or are in that process. So that kind of combines that crowdfunding methodology of getting that equity or getting that funding from a wide range of sources. So you might have 1,000 different people putting in a certain amount of investment for a certain amount of equity. The due diligence process, the things you have to go through there are quite significant. It's kind of starting to lead up to being listed, some of those same requirements. So something to keep an eye on. Just coming to the end of our time, a lot of times just racing through these last few. So the capital raising process, and I think Cam has kind of touched on a lot of that already. So it's just important to understand those various stages. And Cam, you said it's good to just get out there and start that journey, start those conversations. Not expect to be fully funded through one conversation by the first person that you meet with, but really putting yourself out there and talking to a wide range.
Yeah, I think that we so often see businesses raising millions of dollars and it's in Startup Daily or whatever. That doesn't happen that much. It's a hustle. It's a process. It's probably going to take months, if not years. Just recondition yourself to lots of no's. No's are not a bad thing. No's can be a really good thing. They can help you refine your message. If you take yourself from getting offended or hurt about a no to, okay, what can I do better? Then raising will be a lot better process. And don't compare yourself to others. Don't sit there and say, oh, this business has raised 5 at 20 or 5 at 40. Why can't we? It's just about your business, no one else.
Yeah, so there's just all those different stages, reaching out to people, organize meetings. I think I'm a real planner, so making sure that you have the documents in place that people are going to want. A lot of the time you don't necessarily know what those are, but it is kind of similar across kind of things that you need to prepare for grants, to prepare for those incentives, to prepare for VCs, to prepare for obtaining a loan from a bank. It's all those kind of things that people want to see to ensure that they're putting their money in a place that's, hopefully going to give them a return. So it's generally better to be over prepared and reach out to people to really figure out exactly what's required there. And so hopefully they're sign and celebrate. That's what we're all after. So a couple of legal considerations just to finish this off, and this is very related to that planning that I spoke about. If you are beginning this journey, making sure that you kind of understand what the company structure is, what you want out of the business, the venture is. Are you, for the long haul, are you looking to create a vehicle that's going to be attractive to investors and then you're going to exit in 5 or 10 years? So making sure that everything is set up properly, that you have, for example, a holding company and an operating company, if that's the way you want to go, as early as possible, making sure that's set up correctly to facilitate R&D tax incentive and status, making sure that the IP is where it should be from the start to prevent situations where the investor can't invest in that company because it doesn't have the IP. And then you need to remove the IP there, and it costs a whole bunch in legal fees. There's a tax liability potentially for capital gains. So it's always good to make sure that you're speaking to the experts, speaking to the right people to get those things set up, IP agreements, shareholder agreements, etc. So that brings us to the end of the presentation. Just as a little reminder, Fullstack, we assist with all the various things that we've spoken about today. If there are any questions, now is your time. We've just got a few more minutes, so if no more questions come through, we'll jump off. But I just really want to thank everyone for their attendance today. Thank Spark Festival as well, again, for putting on such a great series of events, and big thank you to Cam, who's, I think, very entertaining today. A lot of insight, some real kind of advice from someone who's been there and done it, or is doing it. So yeah, thanks to Cam.
Pleasure, mate. Anytime. Yeah, and I can recommend Fullstack as well. We've used them for a while, and yeah, Jack's one of the best. If you're ringing Jack at 11 p.m. on a Sunday night saying Grant is going to a panel tomorrow, help, and he answers, that's a pretty good sign.
I appreciate that. Rodney just has a quick question, Cam, if you've got a couple more minutes. What are the disadvantages? What are the disadvantages of taking VC money in terms of the demands they place on you?
So look, we've been lucky. CP have never demanded anything other than a fortnightly call, a monthly update, and they've only ever been anything but supportive. So I think that fits into pick your investors wisely. I, though, have heard horror stories from other businesses around VCs wanting to change founders, and my only advice would be to make sure that during your capital raises, the founding team can, especially in the early stages, can keep control of the business. Because if there are shareholders that have more holding than the founding team or can gather together, then there can be issues. I also think that there's a different expectation that comes along when you take VC money. It's not just, okay, we can grow this steadily and we can try and make this work over the next 5 to 7 years. When you take VC money, you need to run as hard as you can and as fast as you can. And if you're prepared to deal with that and potentially take on more VC money and more expectation and run even faster, then, and your business has the ability to do it, look, it's a lot easier hitting a home run than hitting a single in this space. I think sometimes it's, and yeah, but my advice would be pick your VC wisely. It's not just them picking you, it's you picking them as well.
Absolutely, some great advice there to close us out. So once again, thanks everyone for attending today. Hopefully everyone got something out of it, a little nugget here and there. There are our contact details, so if you want to have a follow-up call, have any other questions that weren't addressed in our presentation today, please feel free to reach out. Thank you again to Cam, and thank you everyone. We'll leave it there.
Cheers, Jack. Chat in a bit, mate.